Welcome to episode 81 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hammond. Today, we've got a packed show with a lot of valuable information for you. We'll be discussing whether affordability is back within reach for first-time buyers, new mortgage rule changes, our home of the week, and other top real estate stories. We'll also delve into some intriguing business matters, including exceptional mortgage rates spotted in Canada following a U.S. Federal Reserve rate cut and a sophisticated mortgage scam that tricked elderly homeowners with fake lawsuits. Plus, we'll explore why the Nova Scotia government decided to kill remote work to revive Halifax real estate demand. So, let's dive right in. Efforts to get more Canadians into homes appear to have received a significant boost in recent weeks thanks to falling interest rates and the easing of mortgage qualification restrictions by the federal government. Rising rates since 2022 squeezed affordability and pushed many hopeful buyers to the sidelines. But 3 Bank of Canada cuts since June and a recent dip in fixed mortgage rates have helped brighten their outlook. This week saw another shot in the arm for first-time homebuyers as the federal government hiked its cap on insured mortgages to $1.5 million, allowing buyers to put forward a down payment of under 20% on purchases up to that value, and expanded access to 30-year amortizations. Canadians buying for the first time and those purchasing a newly built home can now take out a 3-decade amortization on their mortgage, further improving the prospects of those frozen out of the housing market. Any move to bring affordability within sight of first-time buyers is welcome, according to Stephen McMillan, an agent with Mortgage Alliance based in Mississauga. He noted the Bank of Canada's recent decisions to bring its benchmark rate lower as a positive development for new buyers, with a drop in annual inflation to 2%, suggesting further cuts are on the way. It's good that the bank took an aggressive approach on rates to curb inflation, which it has, he said. They did reach their goal there, so we're not out of the woods yet, but I think we're heading in a positive direction. Canada's inflation rate hit the central bank's 2% target in August, sparking expectations for a 50 basis point rate cut next month. The government's move to adjust mortgage qualification rules, McMillan said, was a fillip for new buyers. Anytime the Government of Canada makes a very clear decision on improving the landscape for first-time buyers, in particular to get into home ownership, is to be welcomed, he said. The extended amortization to 30 years and increasing the insured mortgage to $1.5 million is a great step for individuals who are trying to get into home ownership. I have the tools now to assist them, to guide them into home ownership, where beforehand it posed a challenge, for instance, not having a required down payment. Still, McMillan cautioned that the government decision is more of a good start to improving affordability rather than a concrete solution. In pricier markets like Toronto and Vancouver, some Canadians previously pushed to the margins may now be able to re-enter the fray, but sky-high housing values are continuing to leave many with little real prospect of purchasing a home. A recent Rates.ca report highlighted that with the average house price in Toronto hovering close to the $1.1 million mark, a household income of about $208,000 is required to afford a property. A daunting figure for any aspiring home buyers, even under the new rules. The study showed a gap of over $92,000 between average income in Toronto and the income required to buy a home, and in Vancouver, the difference is even starker. British Columbia's most populous city requires a household income of $227,000 to purchase the average property, compared with an average actual income of $115,790. Toronto-based broker Elon Weintraub highlighted the struggles many buyers would still face, despite the new changes in a recent interview with Canadian Mortgage Professional magazine. What should agents and brokers be focusing on at present? McMillan said, staying apprised of the latest updates and positioning himself to provide clear and comprehensive advice to clients about what they mean for the market has been a key focus. That's especially important with a flurry of recent news, whether from the Bank of Canada or the government, with the potential to bring about a change in the mortgage outlook. I'm observing what's going on economically because there are a lot of things happening and many variables in place in terms of the housing environment as well, he said. I'm keeping myself informed on what's happening daily so I can assist clients to make the most prudent decision, whether it's their first time purchasing a home, consolidating debt, or even investing in a property. Ottawa is set to ease mortgage rules in a bid to help buyers afford pricier homes. Canadians will soon be able to get mortgage insurance for more expensive homes, and first-time buyers will have the option to stretch out their payments over a longer period. These changes to federal policy aim to help younger buyers enter the housing market. Under the new rules, which take effect on December 15th, the price cap for insured mortgages will rise to $1.5 million, up from the current $1 million. First-time homebuyers will be allowed to take out an insured mortgage with a 30-year amortization for all types of homes. Additionally, more buyers will be allowed to take out an insured mortgage with a 30-year amortization on pre-construction homes, though not all investors will be eligible. The federal government has faced increasing pressure to make housing more affordable for younger Canadians. Industry experts have noted that the announcement of the new mortgage rules is already attracting prospective buyers back into the market. Mortgage brokers and realtors have reported receiving numerous calls since the news broke on September 16th, with inquiries about potential savings in monthly payments and concerns that the changes could drive up home prices. Home sales have been sluggish since the Bank of Canada started raising interest rates in early 2022. Although the central bank has cut interest rates 3 times since June, activity has not significantly increased because mortgage rates remain relatively high. The new mortgage rules aim to ease down payment and cash flow hurdles, but there is a catch. While the changes could help homebuyers access lower mortgage rates and pay smaller installments over a longer period, they would also allow borrowers to take on more debt and pay more interest over the life of the mortgage. Consider a buyer who purchases a property worth $649,096, which is equivalent to the average home price in Canada as of August. With a 10% down payment and a competitive 4.09% 5-year fixed rate, their monthly payment would be $3,198 on a 25-year amortization. If the same borrower opts for a 30-year amortization, their payment would shrink to $2,895, or $303 lower per month. However, by taking longer to pay off their mortgage, they would end up paying more in interest. With a 30-year amortization, the interest charges would total $439,827, or nearly $83,000 more than if they had chosen a 25-year mortgage. In other news, Ottawa's underused housing tax has failed to raise any meaningful revenue. The underused housing tax, which took effect at the start of 2022, was designed to impose an annual 1% tax on the value of foreign-owned real estate deemed to be underused or vacant. The revenue from this tax was intended to be invested in housing affordability initiatives. However, according to documents recently tabled in the House of Commons, the Canada Revenue Agency had assessed just $74 million through the underused housing tax as of mid-June this year. A significant amount of the returns had no amount owing. The Canada Revenue Agency reported that it spent a total of $59 million to implement and administer the tax over the 2 years since its launch. These numbers seem to confirm long-standing criticisms by tax experts, who warned that the levy would impose burdensome tax filing requirements on Canadians who ultimately would not owe anything to the government. On a different note, there is an opinion piece that argues renting is often a better deal than buying because of how expensive it is to own a home. While renting is often perceived as throwing money away, the true costs of owning a home are less obvious and often harder to measure. Major expenses include property taxes, maintenance costs, depreciation, and the cost of capital, which encompasses not just mortgage interest costs, but also the opportunity cost of not investing the down payment. For our home of the week, we have a remarkable pre-Confederation log cabin located at 5588 Wellington County Road 39 in Guelph, Eramosa, Ontario. Estimated to be nearly 200 years old, this 5-bedroom log cabin was named Bleak House in the 1800s after a Charles Dickens novel of the same name. An edition of the novel from that era is still in the house. Today, the cedar logs, squared and dovetailed at the corners, still stretch the full 40-foot length and 30-foot depth of the building. Previous owners converted the original dining room into a primary suite with a whirlpool bathtub and created an eat-in kitchen with wooden cabinets and an island. A large solarium with expansive windows offers views of the property's verdant surroundings and makes for a perfect spot for lounging and entertaining. So, what is the asking price for this historical gem? The options are $1,875,080, $2,380,999, $2,995,000, or $3,699,900. The correct answer is $3,699,900. In a significant development for Canadian mortgage holders, the U.S. Federal Reserve's 50 basis point interest rate cut on Wednesday is making waves north of the border. Financial experts are already discussing the implications for both the Bank of Canada and Canadian mortgage holders. The U.S. Federal Reserve's decision to reduce its benchmark interest rate by 50 basis points is part of a broader strategy to stimulate economic growth. This move has created a ripple effect, influencing interest rates and financial markets globally, including here in Canada. Anne Gaviola from Global News reports that the immediate impact of the U.S. rate cut is being felt in the Canadian mortgage market. Mortgage brokers and financial advisors are observing what they describe as exceptional mortgage rates, providing a rare opportunity for homebuyers and those looking to refinance their existing mortgages. According to Gaviola, the rate cut by the U.S. Federal Reserve has prompted Canadian lenders to reassess their own mortgage rates. Some lenders have already started offering more competitive rates, making it an opportune time for Canadians to either enter the housing market or consider refinancing their current mortgages. Financial experts suggest that the Bank of Canada is closely monitoring these developments. The central bank's next moves will be crucial in determining how long these exceptional mortgage rates will last. With the Canadian economy still grappling with inflation and other economic challenges, the Bank of Canada might consider further rate adjustments to align with global financial trends. The U.S. Federal Reserve's rate cut comes at a time when the Canadian housing market is already experiencing a shift. After a period of high interest rates and cooling market conditions, this new development could potentially reignite buyer interest and stimulate market activity. Mortgage brokers are advising prospective homebuyers to act swiftly. With the current landscape offering such favorable conditions, waiting could mean missing out on the best rates. For those considering refinancing, now might be the ideal time to lock in a lower rate and reduce monthly payments. However, experts also caution that while these rates are attractive, borrowers should remain prudent. It is essential to consider long-term financial stability and not just the immediate benefits of lower rates. Consulting with a financial advisor can help in making informed decisions that align with one's financial goals and circumstances. In summary, the U.S. Federal Reserve's 50 basis point rate cut is having a noteworthy impact on the Canadian mortgage market. With exceptional rates now available, it presents a unique opportunity for homebuyers and those looking to refinance. However, as always, careful consideration and professional advice are key to making the most of these financial opportunities. Ontario police are searching for 3 suspects involved in a complex mortgage scam that has left more than 200 homeowners across the province defrauded, many losing their homes without realizing it. The scam, which originated in Collingwood and has spread throughout the province, involves door-to-door sales tactics, fraudulent remortgaging schemes, and substandard home renovations. The Ontario Provincial Police have already arrested Rajivan Thilainataraja, 39, from Mississauga, and Sajjad Ahmed, 40, from Scarborough. They are facing multiple charges, including fraud over $5,000. Thilainataraja is also charged with laundering proceeds of crime. Canada-wide warrants have been issued for 3 more suspects: Anas Ayub, 23, of Toronto, Mohammed Wakar Afzal, 33, of Pickering, and Mohammed Wasik Afzal, 28, of Scarborough. They are wanted on charges of fraud, conspiracy, and laundering proceeds of crime, according to the Ontario Provincial Police's addendum showed. The scam first came to light in 2021 in Collingwood, where what appeared to be a minor civil dispute over home renovations led to a much larger investigation. Detective Sergeant Jason Lloyd, who has been leading the case since its inception, said that the scheme was far more intricate than it initially seemed. The fraud involved door-to-door salespeople offering homeowners deals to lower payments on services like air conditioning units or air purifiers. But instead of helping homeowners save money, they tricked them into signing mortgage documents. They believe they're signing a legal contract to get out of payments, when in fact they're actually signing mortgage documents, Lloyd said. It is a legal mortgage, but it's been done fraudulently. The victims, mostly elderly homeowners, were then led to believe they were part of a class action lawsuit and that they would receive compensation. However, the compensation they received was actually a portion of the money from their new mortgages, which they were unaware of. It's their own money, Lloyd explained. Then what they say is that the courts have ruled you've won this sum of money, but the courts have ruled that part of this reward money that you've been given needs to be invested into your house. The scam didn't stop there. After receiving the so-called lawsuit winnings, the victims were told that part of the money needed to be reinvested into their homes. They were pressured into signing up for home renovations, which were carried out poorly and at inflated prices. They're thinking, wow, I got the work done, I got all this cash in the bank, but it's their cash, Lloyd said. Meanwhile, fraudsters were using fake agreements to place notices of security interest, NOSAs, similar to liens, on the victims' homes without their knowledge. These NOSAs were later paid off using high-interest fraudulent mortgages. As homeowners failed to make payments they didn't know existed, the mortgages defaulted and some lost their homes altogether. In some cases, the fraud only came to light after a homeowner had died, leaving the property to heirs burdened by debt and forced to sell their homes. The scam has impacted homeowners across the province, particularly the elderly. The interest rates on the fraudulent mortgages were as high as 25%, making it impossible for victims to keep up. It's scary. And we have victims like this all across Ontario, said Lloyd. To date, the Ontario Provincial Police has conducted more than 230 interviews as part of Project Nettle, the investigation into the scam. Victims were offered support from victim services as they navigated the devastating financial impact. In response to the widespread fraud, the Ontario Provincial Police is advising homeowners to check for notices of security interest registered against their property. This can be done by purchasing a copy of the parcel register through the Ontario Land Registry Access at www.onland.ca. The Ontario Provincial Police also highlighted new legal protections under the Homeowner Protection Act, which allows for the removal of consumer notices of security interest registered before June 6, 2024. In addition, the Consumer Protection Act provides the right to withdraw from contracts within 1 year if misrepresentation is involved, and includes a cooling-off period for door-to-door sales agreements. Nova Scotia is the latest province to wage war on remote work as governments try to anchor people to big cities. The government of Nova Scotia has ordered thousands of its non-union staff to work out of the office full-time, starting next month, even those who have not since 2015. The move follows corporate and political pressure across the country to return government staff to the office and return a premium to big city real estate markets at the expense of smaller, more affordable regions. It may provide a boost to Greater Halifax real estate demand, but it is likely to amplify the slowdown in the rest of the province. The government of Nova Scotia is ordering its non-union staff to the office next month. Starting October 15, 2024, roughly 3,500 non-union provincial employees will work in the office full-time. Notice we did not say back to the office? There is a good reason. The government of Nova Scotia is one of Canada's largest pioneers when it comes to a mass adoption of remote work. Remote work was broadly rolled out in 2020, but the province has been running a program called FlexNS that has allowed remote work since 2015. The project was designed to focus on productivity and output rather than physical hours clocked in an office, and save taxpayers the cost of pricey office space in the process. Many of the workers ordered to work in the office full-time have never been required to work in the office. This is a part of a broad trend spreading across Canada called prescribed minimums. These are a minimum number of days an employee is required to appear in a major city office, with the Government of Canada notably returning its workers back to the office earlier this month. Canada Post's non-operational staff will also be joining Nova Scotia government employees in traffic as they begin their prescribed minimums starting October 15, 2024. Policymakers often use buzzwords like, "The plan will improve collaboration and foster community." Many in the public think people are not working unless they are physically in the office. There is little to no evidence to support either of those points, since the plans often do not care when employees come in, and the data shows productivity has actually increased. However, there is plenty of evidence to show this is about real estate, anchoring employees to big cities and reviving business downtown. Governments began to send employees to the office almost exclusively after corporate and political pressure. The country's most expensive real estate markets no longer had people anchored for their careers, and the premium was transferred to smaller, more affordable cities. Halifax downtown office. Woes started before 2020. Those looking for vacant space in downtown Halifax are in luck. There is a lot of it. Colliers estimate 16.4% of space sits vacant, about 1 in 6 square feet of prime real estate. Interestingly, like the province's embrace of remote work, this issue predates the pandemic. The vacancy rate was similar in 2018, when commercial real estate firm Turner Drake and Partners Limited warned it may be an unsustainable setup. Back then, the firm warned the appraisal values will fall, and city revenues will need to decline accordingly. Cities are a little more strapped for cash these days. Various policymakers across Canada have also stated that mandating government workers back to the office is about setting an example. When the pandemic kicked off, it was sold as a new normal, that workers will be detached from the office. Careers were no longer chained to major cities, and workers could move to more affordable regions. After all, even the government was doing it. Now that more office places are asking workers to return to the office, demand outside of the city has completely dropped off the map. The share of Nova Scotia home sales outside of the Halifax-Dartmouth region sit at 51% year-to-date in August. Contrast that with the 2022 peak of 62% of sales in the province outside of the Halifax regional municipality. Most home sellers are likely unaware of the shift since it aligns with rising interest rates. Industry experts have been suggesting rate cuts will revive markets. Though the data shows there is a big shift in the type of homes people are purchasing. If credit stimulus manages to spark more buying, the odds are towards the Halifax-Dartmouth region, not the rest of the province. Policymakers are hoping to cement that. And that wraps up our episode for today. Thank you for tuning in to episode 81 of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamilton. Stay informed, stay ahead, and as always, happy house hunting.